Good morning to those people joining. We intend to give it a minute or two before we kick off. Possibly give us another minute before we start proceedings. Right, I think we're probably there or thereabouts at 10:02. So I'll crack on. So good morning all, and welcome to our succession planning webinar. This morning we're pleased to have over 150 registered for this morning's session. And the intention is to give a flavour of some more of the mainstream succession routes, with input from a couple of guest speakers today in terms of commercial, tax and legal aspects to consider during the succession planning journey. In terms of housekeeping, the running time is approximately 50 minutes, followed by a question and answer session. There is a Q&A box at the bottom of everyone's screen, fingers crossed. So please feel free to submit questions throughout the webinar. We have received a couple of questions in advance of today's session, which we'll try to cover off at the end. However, if we don't get time, we'll come back to people individually and try to field questions and answers as appropriate. At the end of the webinar, obviously, please do get in touch if we've struck a chord in any of the topics we've covered here today. But each of the attendees will receive a recording of the webinar via email afterwards. Today's agenda. So first of all, we'll have a quick kind of round the room, who we are and what our specialist areas of work cover. Before we have as we're joined by Peter, who'll start to touch on the commercial aspects of succession planning, and again, what are the aspects and key areas to consider when building your kind of management teams for the future. Before we then touch on a trade sale, a management buyout, which we'll probably refer to as an MBO throughout, and also an employee ownership trust sale, otherwise known as an EOT, looking at the advantages, the drawbacks with some kind of legal areas and tax items to consider throughout, before touching on family succession and a few of the main routes, before we have a question and answer at the end. Who we are, so my name's Patrick. I head the corporate finance team here at TC Group. We have a team who support clients with growth and funding, which isn't obviously covered here today, together with succession planning. So a lot of the main areas we'll cover off today. We support clients from the outset through to helping them to get the deals over the line with support from tax advisors and legal advisors. We also work on valuation assignments and also the preparation of option reports for our clients.
Patrick, I think you've got to mention that you and your team won Corporate Finance Team of the Year recently for Central and East. Is that right?
Yes, thanks, Joe. Yeah, it was an accolade for the team, but no, it's hot off the press. Thank you.
No, congratulations, well deserved. I'm Joanne. I've been at TC Group for just over a year, and I work with Patrick, Kerry, and Peter, and also the wider TC Group on various tax projects. These include succession, business strategy, employee incentivisation. And also, we mustn't forget the owners of the business and helping them with the tax affairs and meeting their personal and family objectives as well.
Good morning, everybody. My name is Peter Job. I'm a consultant to the TC Group and a chartered marketer. My main focus of work is on helping business owners with their development of the business strategy, business development, work generation, and also coaching members of the senior management team with new business skills.
Hi everyone, I'm Kerry Jimenez and I'm a managing associate in the corporate team at Freeths. Freeths is a full service law firm with 12 offices up and down England. and one recently opened in my hometown of Glasgow. In the corporate team, I deal with legal aspects connected with putting in place documentation for the regulation of companies, such as articles of association and shareholders agreements, as well as dealing with the legal documentation associated with investment into and restructuring of companies. But the bulk of my day job is actually putting in place legals associated with buying and selling companies.
Thank you, Joe, Peter and Kerry. That's much appreciated. To keep us on our toes this morning, we've actually included a couple of kind of poll questions, and there's 2 questions that should, fingers crossed, pop up on everyone's screen. And I'd welcome everyone's input in terms of answering these questions, if possible, to help us to direct what we kind of cover off today. Got a couple of answers have started landing, which shows it's the system's working, which is good. That's excellent. Give it another minute. There's probably a couple more answers due to land. Probably a mixed bag across the board in both responses. No, so that's really helpful, and thank you everyone for your feedback on those points. It's nice to see succession planning is quite high up on number 2. I suppose that's probably the purpose of people's attendance here today. So no, thank you ever so much for your feedback. That's much appreciated.
So today, I'd like to put myself in the shoes of a business owner. And I spend the vast majority of my working life working with business owners and their senior management teams. And these businesses are generally SME businesses, from people, maybe companies that employ under 10 people, from 10 people up to 60 to 70 people. That's generally the range of my sort of working operations. And in terms of things that people are concerned about in terms of business ownership in relation to succession planning, I've gleaned some insight into this over many years. So the following points are things to consider in terms of that process. So the first item really is when to begin the succession planning process. There was a saying many years ago that a business guru quoted, who said you should start with the end in mind. And of course, that's easier said than done, because when you first start a business, you're focused on getting it up and running, generating work, getting paid, and moving the business on. But I think that the simple answer to when you should begin the succession planning process is actually as early as possible. So for instance, in an emerging business, whilst the owners may not be looking to sort of transition and exit for a good while, if they're growing quickly, they need support with other things. So that succession planning journey needs to start then. If you leave it to the end, if you're a mature business, you leave it to the end of the process, the issue can be that you get stuck in the business because you've not started that succession plan process early enough. So I think that the key message there, start as early as possible and be prepared. One of the other main things that business owners tell me is ensuring a legacy survival. So what does that mean? And I think because business owners put their blood, sweat and tears into starting a business, one of the key things they're keen to see endure is the legacy beyond their tenure in the business. So what I'm speaking to business owners about a lot at the moment is what they would like that legacy to look like. And do they feel that that legacy is going to survive beyond their tenure in the business? So that's a really important thing that business owners are passionate about. And I'm sure many of you listening, watching today will resonate with that point. The other key thing is the need for support with critical business functions, because again, when current owners start a business, they tend to do everything. They have to go out and find the work, deliver it, get paid for it. But as the businesses grow and develop, part of the succession planning process is to bring other members of the team with them who are often fulfilling a technical function and don't necessarily get introduced to the critical business functions like work generation until a bit later on in the company's development. So thinking about when you're going to need critical business support, like I say, such as business development. How quickly do you need to get other people upskilled and involved in that process? And the final point on this slide is business skills capability in the senior management team, because if you're going to take people with you and you're going to ask them to fulfill critical business functions, do they have the experience and knowledge to actually do that? Or do you need to set aside some training and coaching with key individuals in your senior management team to actually embed those skills? So there's some of the things that business owners are concerned about. And to help you really prepare yourself for a succession planning process, I developed a very simple four-stage model, the 4A model, which probably makes it easier to resonate with. So in terms of this four-stage model, the first area is availability. So do you actually have members of staff, colleagues in-house currently who you think are capable of succeeding you in the future? Absolutely crucial question, because if the answer to that is no or maybe, it doesn't matter what kind of transition or exit route you're considering, this has to come first, because you've got to have people that can come through and help take the business on. If you need to go externally to recruit people, obviously that's a time-consuming process. You've got to make sure that people are the right fit with the business, and will live through the values that you currently have and the culture. So that's a really foundational piece of thinking, is availability. And then there's aptitude. So you may have people in the business you think are capable of succeeding you, but do they have the skill set and the appetite to become a business owner? Because obviously it's quite a lonely place being a business owner. It's a big challenge, a big responsibility. So understanding who's got the aptitude and the will to actually run a business is really crucial. And the other consideration here is emotional intelligence, because it's becoming increasingly obvious that part of that aptitude skill set is emotional intelligence capability. In fact, I read something recently where it was quoted that 2/3 of a business's success is down to emotional intelligence capability, which is a really interesting facet. Third item is alignment. So are the senior management team involved in the business strategy? Are they in tune with it? Do you as business owners share the business strategy with the senior management team? Are they actually involved in shaping that strategy? Because that's again a crucial element in the succession planning process. If they're divorced from that particular process at the moment, the sooner you can get them engaged in it and prepare them to succeed you in the future is really crucial. And the final point is of course action. No plan is worthy unless it's implemented. So do you have a succession plan in place? Is it documented, or is it just something in your head at the moment? And what plans are in place to embed those business skills into the senior management team if you don't actually feel that they're there? So hopefully, if you can take this very simple process away and use it as a starting point for your succession planning journey, I think that'll just help you to sort of move your thoughts on.
Thank you, Peter. That's really helpful. I suppose, as we're talking to business owners as well on a daily basis around succession, and one of the things that comes up is kind of the management team's attitude to step up, particularly in, let's say, management buyout scenarios, which we'll touch on in a moment. But have you noticed a shift in, let's say, attitude or risk appetite when I suppose developing the management teams for the future?
Absolutely, that's a great question, Patrick. And I think if I go back 30 years to some of the relationships I formed with business owners back then who were starting businesses, they had the responsibility of doing everything, but they also had to take risks in terms of raising finance, sometimes putting their houses on the line. I think if you fast forward to where we are now, there's much less of an appetite to take those risks. And I think this is one of the reasons why an EOT, for example, is becoming a popular route, because it retains that cooperative feel of a business, but it also lessens the risk considerably for the people that are going to come through and become the business owners of the future.
Yeah, thanks, Peter. And again, we'll touch on that in a little bit more detail in the slides to follow. Thank you very much. The next section of the webinar, we intend to cover trade sales, management buyouts and EOTs in a little bit more detail. Kerry and Joe are kind of going to be touching on the advantages, potential drawbacks of each route. Again, looking at the tax matters and legal matters to consider throughout.
Thanks, Patrick. Okay, so the first one that we wanted to talk about was a trade sale. And for those of you who may not know, a trade sale is typically the sale of one trading entity to another trading entity, and that other trading entity may be backed by private equity or other debt finance. So some of the potential advantages in connection with a trade sale as compared to some of the other routes that we'll look at in a little while are that you typically tend to see increased consideration multiples, and these are largely driven by the competitive processes that you find in a trade sale, i.e. that there's more than one buyer, and that is driving the price up, and or there are synergies between the buyer and the target entity that can be utilized post-completion, such as consolidation of departments, HR, IT, and or properties. Another really key attractive feature of a trade sale is that you often find that there are accelerated payment terms. And this is usually because a third-party buyer is funded either by way, as I said a moment ago, by private equity backer, or that they've been out and sought some form of acquisition debt finance, or alternatively that they've got cash on the balance sheet and they're purchasing the target with that cash. And as such, in some circumstances in a trade sale, a seller can expect to receive a larger proportion of their consideration up front than they would if they were perhaps going down the MBO or the EOT route. Although I would say, though, that there's a current trend in what we are seeing in the M&A deals that we're working on although you might get a larger proportion up front, there is a tendency for some of the consideration to be deferred. Sometimes on earn-out terms, which are linked to how the business is going to perform in the future. So that's just something to bear in mind. Where there is deferred consideration, a seller would typically expect to be provided with some form of security in respect of that consideration, and you might see this by way of security over the assets of the trade buyer, for example. And this is something that you just don't tend to see in a management buyout, because the only security that there could possibly be is maybe the target, and that's the business that you've just sold. Looking to some of the potential drawbacks of a trade sale, the first one that I've listed here is a comprehensive due diligence process. So just to quickly explain what due diligence is, it's when a buyer comes and looks under the bonnet of your business, and in doing so, they will be asking many questions about many different areas of your business, the corporate matters, the property matters, the matters connected with employees, intellectual property, the list goes on. And that process can be fairly cumbersome, and it can be a large drain on resource for the sellers. It often takes a lot of time to complete the due diligence questions that are raised by the buyer. But it's necessary for a third-party buyer to do this, because obviously they don't know anything about the business that they're coming in to potentially acquire. So they need to really get under the bonnet and understand what it is that they're going to be buying. Obviously, associated with that is a confidentiality risk. If they're going to be a potential buyer is going to be looking over your, standard contract terms, your customer lists, your supplier lists, your pricing lists, for example, you might be giving away some really key confidential information. And whilst we can seek to protect that by legal documentation such as confidentiality agreements and non-disclosure agreements, the risk does still remain. Additionally, with trade sales, we tend to see, by comparison to MBOs and EOTs, that there's a higher completion risk, and this just means that they're more likely to fall over before getting to completion. And that often is because, for example, during the due diligence process, a buyer has maybe found a skeleton in the closet that it's not happy to proceed buying the business with that risk in place, so they would pull out. So the completion risk on a trade sale tends to be a little bit lower than that of an MBO or an EOT. Connected with the warranty coverage, connected with the due diligence, is warranty coverage is likely to be extensive. And again, this is typically because a third-party buyer is coming in not knowing anything about the business, and they're seeking protections for themselves about the state of the business that they are acquiring. You'll notice there that I put on both of those advantages and disadvantages is that there are arm's length negotiations, and that's because legal negotiations can be extensive when they're on third-party arm's length terms, but in being so, it often means that they are detailed, and it means that we've got protective mechanisms in place to minimize exposure on both sides of the transaction, so for the buyer and the seller. However, you know, as a lawyer, I like to approach my transactions in a collaborative manner. And so whilst I'd always seek the best protections possible for, you know, my client that I'm acting for, and point scoring on unnecessary legal points, it doesn't achieve the common goal any quicker. So you don't need to be daunted or overwhelmed by arm's length legal negotiations, but it's just a point to note that they tend to be more extensive when you've got a third party buyer.
Thank you, Kerry. In terms of the tax, when looking at a trade sale, the first thing we need to look at is, are we actually selling individual assets and the trade of the company, or are we selling the shares? Which will be right will actually be determined by the circumstances at the time. But generally what we find is that for a seller, a share sale is more beneficial from a tax perspective. And the reason for this is that an asset sale can incur a double tax charge. So you might get a tax charge, well, you will get a tax charge on the gain in the company, and then again on when you come to extract those funds from the company. The gains on a share sale are subject to capital gains tax. So the main rate being 20% where the shares are sold by an individual, or 19 to 25% if in a company, depending on the size of that company. However, there are reliefs available that can mitigate these exposures. So probably the most well-known one is business asset disposal relief, formerly entrepreneurs relief. Now, this relief can reduce the capital gains tax on the first 1 million of gains to 10% for individuals, as opposed to the 20% main rate. The 1 million is a lifetime limit. Therefore, if you've claimed some relief under this previously, you would need to take that into account now when calculating relief available. We also have substantial shareholders exemption, and this might be available for a corporate seller. For example, if a holding company is selling shares in a trading company, if this relief applies, then no tax would be payable on the gain within the holding company. Should the sale be through what we know as a share for share exchange, whereby the seller receives shares in the buyer or loan notes, then the gain might be rolled over. And it should be noted that the gain will still eventually come into charge, but when the shares are sold or the loan note is cashed in. One of the things that Kerry mentioned was deferred consideration. You know, as she said, this is not unusual in a sale, and generally there is some amount that's deferred, and that can be deferred over various periods from 6 months to a few years. So that just needs looking at very carefully, just to ensure you understand the tax treatment of that deferred payment. The reason for this is that those payments can be structured in a number of different ways, and depending on how it's structured will determine the tax treatment. And as with all things tax, the devil is always in the detail. So if the amount of the deferred payment is known at the time of sale, you will be taxed on this up front, incurring what we call a dry tax charge. So a dry tax charge is effectively you incur a liability now on monies that you've not yet received. If it's unascertainable, or it depends on how a business performs post-sale, or for example, it's an earn-out right, then we will need to value that right, and capital gains tax will arise each year when the payment is received. And it's likely no business asset disposal relief would be available on these future payments, but this would need looking at. Where consideration is paid either in equity or loan notes structured as a non-qualifying corporate bond, so this is a non-QCB in the purchaser, it is likely the capital gains on this consideration will automatically roll over into the new securities. Payment of the tax on the gain in this instance, therefore, is deferred until the disposal of that new security. And often these new shares will not qualify for business asset disposal relief, and therefore that relief can be lost. If this is the case and those original shares did qualify for business asset disposal relief, it is possible to elect to disapply the rollover so that actually the business asset disposal relief can be obtained. And this effectively brings the tax into charge now. Where consideration is paid, on the other hand, in qualifying corporate bonds, so QCBs, in the purchaser, the gain on the consideration, it will crystallise now. However, the assessment is deferred until the sale of those QCB loan notes. And again, in terms of business asset disposal relief, at the time those loan notes are sold, business asset disposal relief will only be available if the qualifying criteria is met at that time. So, for example, it's your individual's personal company, you're an officer employee of the group, and you've held, the business asset disposal relief has been available and qualified for the previous 24 months. Sorry, getting my tongue tied there. Again, as it is possible to lose this relief if you did qualify on the original sale, again, you can elect to disapply the actual rollover and obtain the business asset disposal relief now. It is also important to note, and this is often overlooked, that where there are deferred payments in place, care is needed to ensure that HMRC do not tax these payments as income rather than capital. And this can happen when someone stays in the business. And therefore, it's important that this is looked at very carefully. Given the different treatments and different ways deferred payments can be structured, and the tax that relates to these, we always recommend that advice be obtained. And you should note that where gains are rolled over or deferred, they will be taxed at the rates in place at that time. So, for example, if you've got a sale now that and the tax rate's 20%, and you've got some deferred amounts, those deferred amounts, depending on the tax treatment, if they're going to be subject to tax in a year, 2 years, and the tax rate's gone up to 40%, then it's the 40% that you'd pay. It doesn't matter that the original sale had a 20% rate. Therefore, there are instances where we do wish to trigger gains now, even though we do not have those proceeds. So in summary, there are basically 3 issues to consider when looking at deferred consideration, and these are the tax treatment of that deferred amount, business asset disposal relief, is it available, could it be lost, and the timing of when the tax is payable.
Thank you, Jo. That's really helpful. So I suppose coming back to Kerry's points, it's trade sales can be incredibly attractive. You can receive increased consideration and get your money sooner, but it's not without its risks. But again, it's one to consider, because if there's any deferred consideration or bells and whistles attached to the price being offered by the buyer, advice is required, really. Coming back to one of your comments earlier, Kerry, are you noticing anything or any key areas of housekeeping or due diligence that the attendees here today should be focusing on in the run up to a sale?
No, the answer to that is not key areas, because the key area of important due diligence will largely depend on the business and the sector that it operates in. So that just varies from business to business. However, across all businesses, a buyer will always be expecting to carry out due diligence in some of the very common areas, and they will expect a virtual data room covering these areas to be populated with the relevant documentation, answering their queries or backing up and providing copies of the documentation that they've asked for. And those standard areas that are covered in almost every single transaction are areas such as your standard terms of business. So if you've got those, having copies of those to hand and populating them in the virtual data room. Intellectual property, if it's applicable to your business, then copies of the documentation associated with that. Any and all documentation relating to the properties that your business occupies. and also like standard terms of employment and your company handbooks and HR policies, etc., all associated with the employees. Those are some of the key areas that a buyer will always look at. There are too many more to go into just now. So it just depends basically on the business and the sector.
Okay, no, that's really helpful. Thank you.
Okay, so the next type of sale that we'll quickly touch on is a management buyout, an MBO, and this is kind of what it says on the tin. This is a sale of the business to the existing management team. So first of all, just looking at some of the potential advantages of a management buyout, because this transaction is what we might term internal, i.e. it's not a true third-party arm's length transaction. On an MBO as compared to a trade sale, you can typically expect to have a bit of greater control managing the transaction process, and that just comes down to the fact that you're all operating in the business day to day. Aside from the transaction, you're probably sitting in the same office as some of the management team, and you're able to chat through things associated with the transaction with greater ease than a third-party arm's length buyer. And connected with this is, as I said, on a trade sale, that sometimes there's a greater completion risk. Conversely, on an MBO, because the parties are all kind of operating together, there tends to be a higher completion rate of an MBO by comparison to a trade sale. And as you might expect, the due diligence process can be less intrusive, and that's just simply because the management team are already involved in the day-to-day running of the business. The due diligence process can be a lot more streamlined. They probably already know what your standard terms of employment look like and your standard terms of sale and supply, etc. So the need for the long list of due diligence questions that you might expect from a third-party buyer is less required. And I guess side by side with this is, of course, that because the management team are already operational in the business, there's a reduced risk of confidentiality issues, and that the warranty coverage in the transaction documentation, you can expect for it to be more what we call light touch than if you are selling to a third party buyer. However, whilst those are some really good positives, and having higher completion rates is obviously very attractive, some of the drawbacks are that you tend to see lower valuations, lower multiples on MBOs by comparison to a trade sale. So you might end up with less cash in your pocket at the end of an MBO by comparison. And it typically tends to take you longer to get your consideration. There are often extended payment terms associated with management buyouts, and you can see them significantly extended, sometimes over 5+ years. And that's quite similar as well on EOTs, which we'll touch on in a minute. Compared to a third-party buyer where you would hope for your consideration all to be getting paid inside 2 to 3 years, really, at the outside. And of course, there is a risk to relationships during the process. And whilst I said you're all sitting in the same office and you can collaborate and get things done and get the transaction completed, there will still be sticky points that legal negotiations that need to be had, and of course that can put a risk to the relationships that you've already got in place. And then just going back to one of the first A on Peter's 4 stages of success to succession planning success is availability. You need to have that management team in place, and they need to have the aptitude. They need to be ready to take on, take on and run the business. So an MBO is only really as successful as the management team that you've got in place, and if they're ready and willing to do so.
Okay. In terms of tax on a management buyout, this is very similar to a share sale, and therefore all the matters in play for a share sale should be thought about. So capital gains tax rates will come into play, business asset disposal relief. Do you qualify for that? And also deferred consideration. How should that be structured, and what would it look like, and how will it be taxed? So as I say, it's generally all the things that we've just mentioned under a share sale, and so again, seek advice as appropriate on that.
Thanks, Jo. Some of let's say a lot of the clients we're talking to at the moment, clients are coming to us with the, on the basis that capital gains tax rates are favourable at the moment, particularly around business asset disposal relief at 10%. And I know that's a little bit of a political football with the rates, that lifetime limit moving from what, £10 million years ago to now £1 million. I was just going to ask, as we head into a general election year, and the risk of a change of government, what are your thoughts on how that might impact capital gains tax?
Well, I wish I had a crystal ball, Patrick. I really do. But I think we'll have more of an idea sort of nearer the time. But certainly what we're finding at the moment when talking to clients is that there's a feeling that capital gains is likely to change. And if it changes, it's likely to increase. And I mean, there has been discussion for a number of years on whether entrepreneurs relief or business asset disposal relief, as it is now, will continue, given, as you've just mentioned, it has reduced. So yes, there is a definite feeling and a political push for the capital gains tax rates to be increased. And what we're finding in that respect is some people who might have been looking, post 2025, 2026 to sell, are now bringing that forward in the hope of banking that the reliefs and that lower tax rate, so that they're almost thinking about, even if the company's not quite where they'd want it to be in terms of valuation, is it better now to get money in the bank at a lower tax rate than wait a couple of years, there'd be a higher tax rate, and actually, when you take into consideration, yes, the company might be worth more, but they're paying more tax on it. So it's weighing up what people think is best, but we're definitely seeing people pulling sales forward by a couple of years, purely because of the speculation around capital gains tax.
Thanks, Joe. And yeah, you're absolutely right. It's certainly driving behaviour and the old, what's keeping business owners up at night. And obviously, if it's a business that they've developed and it's got tangible value, you don't want to see, the tax rate double potentially, because you might have missed a window to crystallise the value. So yeah, whilst management buyouts have sort of, I suppose, also greater flexibility. It's so we're working on a couple of, let's say, transitional management buyouts at the moment now, and we've coined the phrase transitional on the basis that the owners aren't ready yet to kind of step away fully, but probably the next 3 to 5 years they will. And as such, we're working with your tax team to ensure they crystallise the value today at favourable rates. I suppose in summary, and again coming back to Kerry's points, management buyouts are, there's more chance of them occurring, however, potentially lower valuations. But again, coming back to one of Peter's earlier comments, and if the legacy of the business that the owners have built and developed, you want to pass on to the next level, it's working out a management buyout structure may satisfy that. One common misconception, I suppose, from some of our clients or some of the colleagues we've dealt with is, we've got a fabulous business, we've got management team with the wherewithal to take this business forward, but they don't necessarily have the funding or the cash resources to buy us out. So again, we work on structures to support, I suppose, a payment up front and a payment over a duration, usually from business profits, so that the management team don't have to stump up the full proceeds that the sellers are expecting on completion, which again it does help us to work on transactions really. Moving through, so the next area we want to cover is employee ownership trusts. So this, although they've been around since 2014, we're probably seeing more and more of them in recent years, and I know their popularity has continued to increase year on year. I'm not sure of the direct correlation, but when I mentioned earlier that the £10 million lifetime limit for what was entrepreneurs relief at 10% moved to £1 million at 10%. It certainly brought a few more clients to the door in terms of asking about an employee ownership trust and considering the options around employee ownership trusts. So they have some fabulous advantages, but also some potential drawbacks as well, a little bit like the MBOs. They are similar to management buyouts. There'd be a new company set up in both an employee ownership trust structure and possibly a management buyout structure. The main differences are the employee ownership trust route would typically be run and operated by trustees. It's worth noting that there is a consultation underway at the moment with HMRC, looking at the structure and the governance. But I think HMRC's view is they want to make sure that the intention of the employee ownership trust route is to genuinely reward employees rather than for any sellers to obtain any kind of tax advantages. And whilst there are fabulous tax advantages, so as our view is in the right purposes, they're excellent, but they've got to be kind of operated for bona fide reasons.
Yeah. So as you've just mentioned, Patrick, an EOT can seem to have significant tax advantages, but to benefit these under an EOT, you must sell between 51 and 100% of the shares to the employee ownership trust, thus giving them a controlling interest. One of the popular misconceptions is that this means that then the employees, determine everything that happens in the company. That's not the case. The employees do not run the company. This is still done by the directors and the management team. The employees then just have a bigger voice, shall we say, that they have a say, that the company that's got an EOT structure has to be run for the benefit of those employees and take into consideration the employees. So you usually have sort of an employee board that reports into the management team or the directors. The shareholders do not have to exit the business, so they can stay within the business, and they do not have to sell all of their shares. So as I say, there just must be at least 51% shares go into the employee ownership trust. So they could, for example, leave 49% shares outside of the EOT, and this could be to facilitate a partial management buyout, or it could be to put in place maybe a share option plan, such as an enterprise management incentive, that's an EMI, or indeed they might just want to keep some of the shares for themselves. The company also needs to be a trading company or part of a trading group to be able to look at the employee ownership trust structure. Another thing to take into consideration is that it must be open to all employees. So all employees must be able to join and benefit from the employee ownership trust, although the level to which they benefit can be geared towards different things. So, for example, there might be sort of level of service might be one of the popular things that people generally look at in terms of the point scoring for how they benefit under that trust. In terms of tax benefits, as we say, there are substantial benefits. For the seller, there is potentially no capital gains tax to pay on selling those shares to the employee ownership trust. There are also benefits for the employees in that they can be paid a bonus of up to £3,600 per year, income tax free, which for the majority of employees is probably a significant amount. When you think of the grossed up amount they might need to earn to take that as take home pay. So say there are some generous benefits associated with it, but you shouldn't do it purely for the tax savings.
Thank you, Joe. You'll see here we've actually, the next slide includes, it's quite a high level comparison of let's say a management buyout versus an EOT. And it's probably worth noting from the outset that I suppose the timing of MBOs and EOTs are fairly similar. So, and again, it wasn't something that was on the earlier slides, but a trade sale can go through a rigorous arm's length negotiation and due diligence process, whereas management buyouts and employee ownership trusts, from start to finish can be concluded within, let's say, 2 to 3 months possibly. An MBOs possibly, but EOTs in every instance that we work on, we actually seek HMRC clearance, and the valuations we prepare are also submitted as an appendix to HMRC. But you'll see from the table on the screen that actually, it simply looks at the, let's say, a £5 million valuation or agreed sale price. We've used an example here whereby £500,000 may be sitting in your business bank account as surplus or free cash, typically the funding over and above the working capital needs of the business. Whilst third-party debt funding is available in both EOTs and MBOs, and we've worked on raising finance for clients, in the example we've put here would be simply a deferred consideration method, whereby you, the sellers, would receive the remaining consideration, let's say over the next 3 to 5 years. although the largest differential here is this CGT rates, obviously the 0%, the no gain, no loss you receive on an EOT sale versus the 10 and 20% based on kind of business asset disposal relief and the main rate of capital gains tax. So there's an obvious kind of net increase in proceeds through an EOT. But actually, one of the main drivers quite often with our clients on which route they go down here, if they want to look at both, is how's that going to land with our management team? And quite often it can simply be that if you've got a couple of people in your management team who are chomping at the bit, their drive and motivation is to be business owners and hold a share certificate and kind of have that title above the door. Quite often an MBO could be a better route or a more favoured route to continue the legacy versus an EOT, even considering, let's say, the tax savings and benefits the sellers may receive through an EOT. It is worth actually noting that a number of the EOTs we've supported with clients, that the main drive has actually been in terms of attraction, retention, and incentivization of key staff. So again, it was one of the kind of the second poll question around kind of one of the challenges for business owners, and some, a lot of our clients have found, offering incentives to your workforce, be it hybrid working, remote working, perks and add-ons in terms of the remuneration only is a key item that employees are considering at the moment. So, joining an employee ownership or employee-owned corporation or group versus, a non-employee owned obviously has its benefits. So again, a lot of our clients who've been through EOT sales are using that to promote, not only to their workforce, but also out externally to their customers, suppliers and stakeholders. One of the key differentials is also that an MBO would also be looking for management to put some money in. Coming back to my earlier statement, we try to structure MBOs so that it's not punitive for management team to buy in. We set levels of which make it affordable and possible. But in EOT, there's no requirement for employees to put their hands in their pockets, so to speak.
Patrick, would you mind if I just ask a question on the EOT side of things just now? I was just wondering whether in what you're doing on EOTs, you're seeing any particular business sectors or industries that an EOT is better suited to?
Yes, as you say, we've worked on a number of EOTs. Kerry, I think we've probably concluded around 10 in the last 12 months EOT sales. The majority actually are probably people-orientated businesses. What I mean by that is it's probably professional services. We've worked with, construction and professional services in the construction industry as well, architects, surveyors, cost consultants, but also some financial services and advisory companies. So whilst I'm saying that it doesn't mean a manufacturing business it wouldn't work, or a joinery business it could still work, but a lot of the businesses that we're talking to or we've concluded have actually been in professional services, which I think from memory, I think about over a third of the reported EOTs by service and sector, I think, are professional services, and I think that's reported by the Employee Ownership Association, who kind of head up and under the board for EOTs. So I suppose in summary, MBOs and EOTs have their advantages. There's no one size fits all. MBOs have added flexibility. EOTs have, let's say, a stricter criteria to meet that favourable tax rate. But obviously, what we tend to do is talk to clients in terms of what works for them, what works in terms of the legacy of their team, and also what's the tax position, with input from say Kerry and Joe. I'll probably just kind of rattle through this slide on the basis that it's kind of a follow-on from what we've been talking through. So we also work on a number of, say, family succession routes with clients. So this is normally, family-owned businesses where the ownership is being passed, let's say, through generations. And quite often there's, let's say, two main routes here. The first would be a share buyback, or what's known as a purchase of own shares, where the company can simply, let's say, acquire the shares based on its cash reserves, assuming it meets the eligibility criteria, to write a check to buy out one of the family members for all of the shareholders, for their shares to be uplifted appropriately. But the care has got to be given here that you meet the criteria, and also that the seller, I suppose, having their shares acquired by the company, also qualifies for capital gains tax. If share buybacks are not possible, we can structure what we call here as a holdco buyout. So it'd be very similar to a management buyout. So we've got a couple of these we're working on at present, where we've got family ownership looking to pass the business down to their children. the business may not have, coming back to my earlier example, the £5 million to write a check out of its reserves, but a holdco buyout can allow, let's say, the parents to step back, the family members to step through, and also, as you say, to crystallize favorable tax rates as they stand today, without the family members coming through having to put their hand in their pocket and write a check for the full amount of the proceeds.
Okay, and I think just to pull it all together in a similar way to Peter mentioned at the beginning, you need to start, it's never too early to plan for the sale. It's also important that you don't overlook your post-exit position, and plan and are aware of that. So some key things to think about here are ensuring that if you remain in the business, any deferred consideration does not get charged to income tax. Be aware that if you've got shares in a trading company that you're selling, you will be effectively swapping a very tax efficient asset, being those shares, to cash, which is tax inefficient asset, so to say. So shares in a qualifying trading company can obtain 100% business property relief, meaning no inheritance tax arises on the value of those shares on death. However, post-sale, you'll have cash, and this would be subject to inheritance tax at 40%. So it's just to be aware of that. Again, in respect of deferred consideration, over what period should this be spread, and how should it be received? Also, be sure you're ready for when those tax liabilities will arise. What you don't want in this regard is any surprises. Also, if the consideration, you don't receive what you expected to receive, but you've already been taxed on it, then obviously you need to look at, can you make a claim to get some tax relief for that in that situation. And finally, just a couple of little points finally, just also don't forget to look at your will. Does it need updating following the sale? And in terms of investment, obviously you could have a substantial amount of cash. What we would say in this respect is don't rush into anything. Ensure you take time and give sort of investments and things the due consideration and time they deserve before rushing into doing anything in that respect. To say all of these things should be thought about throughout the process of succession planning, and you should be able to discuss these with your advisors. So when looking at a potential sale.
Thank you, Jo. That's really helpful, because you're absolutely right. We're all of us kind of around the table here. We work incredibly hard to get clients to achieve their ambitions in terms of crystallizing the value of their shares into cash, let's say, at the end of their, let's say, journey. But then you're right, it just moves the dial in terms of the tax focus. So then they need to start thinking about inheritance tax and the exposure that cash could have, and take further advice and planning, which is a valid point actually that sometimes gets missed. To wrap up, I have noticed that there've been a couple of questions that have been posed. So I'll looking at the time, I intend to just pick up on those. The first question, it says, in regards to getting my business to a level that's interesting for buyers, what aspects should I work on improving in the next 10 years? So any takers on that one?
I'll start off if I may. I think one of the key things, it'll come as no surprise, is it's your people, because if it's a trade sale, for example, the people buying the business will be looking extremely hard at the next generation, because effectively what they're buying is the capability of the next generation of people. In an MBO or an EOT, the current owners will again be looking at the quality and capability of people in terms of running the business and developing the skills or the business skills that they need. There's also got to be obviously a strategic plan, a written business plan, business development plan to accompany that as well. So it's really about those things, and possibly also another ingredient. And one of the things I'm increasingly speaking to my clients about is what kind of data have you got in terms of the financial performance? Because I do a lot of work in the built environment sector, and quite often clients don't have good data streams in terms of which clients, sectors and projects are actually making money and which ones aren't. So you've really got to think about what kind of systems and processes do you have in place to actually do that performance analysis, so that you can direct not only the business model and the business strategy, but also your business development efforts.
Thank you, Peter. And actually, the next question is probably also answers this point. So the next question is how is a business valued? So again, it probably carries on from what you've just been saying about having robust financial reports. So I'll probably pick up on this one. So businesses can be valued in a number of ways. Looking at a lot of the owner-managed businesses that we deal with, we typically look at the balance sheet values for let's say businesses that are kind of like asset rich or have investment arms, but also earnings multiple values. So looking at the underlying earnings of the company over a period, normalizing those earnings. So making sure any exceptional or outlying factors or costs or income are excluded, and then applying a multiple to those earnings, which usually gets us to a magic number, sometimes plus cash, quite often plus any kind of property or less debt. So the earnings multiple valuation is most common, although subject to the business and the type of business. We'd also look at things like discounted cash flows and dividend yields under certain circumstances. But fundamentally, you're right, Peter, on your earlier comment is, having, let's say, quality of earnings and robust financial reports also back that up, which is really helpful. The next question, I think we've probably got time for the next one, is how would I go about finding buyers when the time comes?
That's obvious, isn't it? Instruct Patrick and his team.
Well, yeah, I'm not sure. So yeah, finding buyers is actually, so I assume this means finding trade buyers versus finding let's say MBO candidates or MBI candidates, but I'll take it on the basis of you're there, you own and run your business. How do I find a buyer? So in a way, and it comes back to one of the drawbacks I think Kerry flagged in terms of the trade sale is confidentiality. So quite often, you wouldn't necessarily want to spook your employees, your customers, suppliers, or even stakeholders that your business is for sale. And on that basis, we typically would build up a target list and have more of, let's say, a rifle shot approach to confidentially target and knock on the door of a couple of the buyers who think may be interested on a no names basis. But quite often we have clients who are comfortable that their business wouldn't be identified in a crowd, and quite often we then run more of like a scattergun approach to kind of post the business for sale on kind of wider networks and platforms to try and find a buyer quicker. But yeah, there's no exact science, and throughout, I suppose we have to manage confidentiality. I'm mindful of time, and I know there's a couple of questions that landed in advance of this. So what we'll possibly do is come back to those individuals following the seminar. So to kind of wrap up, I want to thank everyone for watching and taking their time out this morning. Our marketing team will be following up with a recording of today's session. But please do get back in touch if we've struck a chord of any of the topics we've covered today, or even if you want to have a chat to go into more detail around one of the succession routes that we've picked up. Many thanks, and enjoy your respective days.